Good morning, ladies and gentlemen. Welcome to this morning's webinar entitled Hotel Insolvency, Why is this time so different? Which we're delighted to welcome you to, and we're delighted to co-host alongside HVS, Bird and AlixPartners. We're joined today by some exceptional speakers and experts who will clarify thinking and tell us what we need to be considered during this period of time and what the expectations are over the next year or so as we work through this. But we do want to hear your thoughts, so please do use the Q&A button, and we will try and endeavour to get back to every question posed either during the panel or later through a personal message as well. So please do write to us and do let us know what you're thinking. There is no doubt that this period of time, the COVID crisis, has been a major shock to the system, which is naturally will have its casualties. But what can we expect? And will this be different to the great financial crash of 2008, 2009? There are forecasts being published at the moment, which I'm sure many of you have read, which indicate that the hotel industry will take 4 years to return to 2019 levels. Do you agree? It's been commented that the outlook is the bleakest since the 1970s. In terms of insolvencies, the forecasts naturally vary from country to country, and there's real concern over what we may be expecting. One report commented that the growth of corporate insolvencies in 2021 will be around 26%, with a number of countries being the most affected, including Spain, Australia, France, and Netherlands. Again, what do the experts think on this? What are the changes in the law perhaps we've missed and how that impacts? And is the system now more supportive of recovery than perhaps it was in the past? All questions we'll find answers to, discover the answers to. So thank you for joining us this morning for this very important subject, one which I suspect will actually become more and more dominant as we move forward. Now, may I take this opportunity to welcome Karen Free from Bird and Bird to come and ask some polling questions. Karen, over to you. Welcome.
Thank you very much, Chris. Good morning, everyone, and a very, very warm welcome to the latest in our webinar series that focuses specifically on the hotel and hospitality sectors. So I'm going to kick off this morning by asking you to deal with 3 polling questions, which will give us all a good perspective on your views about certain matters. So Lauren, if we could go live with the questions, please. So if you could all vote by ticking the appropriate box. So could you please indicate which part of the hospitality sector you're most closely involved with? Is it finance, whether at unit level or central office? Is it operations? Is it development, marketing, sales, or other central office functions? Are you involved in ownership? Are you an investor or involved in private equity? Is it the banking fraternity or other lending organisation? Are you in advisory, consultancy, legal, accountancy, architectural design, or are you in education? Are you a student? So if you could take a minute just to complete the appropriate button. I see we've got quite a few advisors and consultants on the call today, but also a healthy showing of owners, investors, and people in private equity, which is great. If we have the second question, Lauren, please. Could you please indicate your role within your organisation? Are you chairman, partner, owner, director, or C-suite? Are you a hotel GM or a senior manager? Are you a department head, supervisor, operative, or other? If you could tick the most relevant box, please. Thank you very much. So that's excellent to see. We have 43% of delegates today in the chairman, partner, owner, director category. And our final polling slide, please, Lauren. When do you expect material levels of insolvencies to start occurring? Insolvencies, I'll start that again. When do you expect material levels of insolvencies to start occurring in the UK? before the end of Q1 2021, Q2 to Q3 2021, Q4 2021 onwards, 2024, or do you think there will not be a material increase? If you could let us know which you think of those is most appropriate. We are going to ask this question again at the end of our session today, because we'd like to know if your views have changed at all in the light of the discussions that are going to take place. So 70% of you think that material levels of insolvencies will start in Q2 to Q3 2021, which is extremely interesting. Let's see if that perspective changes by the end of the conference. So without further ado, I'd like to hand over to the first of our presentations today, and we will be hearing from Ben Browne and Graeme Smith of AlixPartners. So Ben and Graeme, over to you.
Thanks very much, Karen. Appreciate that that introduction. So, thank you all for joining the webinar today. My name's Graeme Smith. I head up the hospitality and leisure team at AlixPartners. I'm joined today by my colleague Ben Browne, who's a restructuring specialist. And Ben has worked with me on a number of hotel restructurings in recent years. So in this session, we're going to provide our perspectives on how the market today compares to that of 2009 at the time of the Great Financial Crisis, to try and help explain why so far insolvencies have been very few and far between. We'll then discuss the structure of the hotel market and how this impacts insolvency situations and the key issues that need to be addressed. So I often get asked, when will we start to see insolvencies in this hotel market in the UK, and why haven't there been many already, given the depth of the crisis that's being faced? Now, I think there's a number of key aspects that are different now compared to back at the time of the GFC. First point is that the credit risk is held much more broadly across the market this time, with debt being provided by institutions ranging from banks to credit funds to insurance groups. And what this has meant is that institutions are better able to absorb issues due to the fact that there's a reduced concentration in single asset classes, so that risk is spread. Also, heading into this COVID crisis, leverage levels were lower than at the time of the Great Financial Crisis, so equity cushions are on the whole larger than they were back then. Both these factors provide greater flexibility and provide the ability for businesses to absorb the shocks that they've suffered. Acting against this is an increase in the complexity of financing structures in recent years. The tighter yields that we've seen in the market has driven a need to reduce the cost of capital in order to make the valuation equation work. So we've seen an increased use of tools such as sale and leasebacks, ground rents, and REIT structures. This increased complexity in financial structuring has actually reduced the headroom available to absorb shock, so offsetting some of those positive aspects. But the two most important factors, I believe, that are keeping insolvencies at bay at the present time are, first, that there is still an expectation, or perhaps a hope, that there'll be a rapid recovery next year when we see the vaccine rollout. And so investors and owners see the ability to bridge back to a recovery in their value, and they don't want to give up on that yet. So when it comes to a call for new money and fresh capital, owners have been stepping forward. Second, there's been significant government financial support and protections provided for the benefit of borrowers, which is also enabling them to survive and bridge through to the other side at the current time. So all of this means that currently this is a liquidity crisis rather than a solvency crisis. And there's been sufficient funding and support available in order to bridge through to what are perceived to be the brighter lands of 2021. Now, how long this situation can be maintained remains to be seen, and we've seen from the polling questions that there's an expectation that actually through the middle of next year this will become an increasing challenge. So I'm going to look now at the structure of the hotel market and how that impacts insolvency and restructuring situations. And the structure of the hotel market actually creates certain challenges that need to be managed in insolvencies. The separation of bricks, brain and brawn, if you will, adds complexity and increases the number of stakeholders that need to be dealt with. The property owner, when separated from the operations, either through a management contract or a lease situation, can be distant or lack the visibility of the financial performance of the business. And this can impact their ability to practically assess the options available quickly. The operator of the hotel may be a third-party management company or the brand itself, and they have control of the day-to-day operations and also the management information. Now, this operator may or may not be experienced in dealing with insolvent situations and the particular issues that creates. Finally, the brands. Now, the brands are rightly focused on maintaining the maximum number of brand compliant flags in the market. And their contracts can often contain protections that make them difficult to terminate, even in an insolvent situation if that's desired. They're of course also vital for bookings and setting the operational requirements. And finally, on the potential CapEx needs that may need to take into account looking at an eventual sale. So some complexities to manage. And I'm going to hand now to my colleague, Ben, who will cover in more detail the stakeholder issues. Ben.
Thanks very much, Graeme, and good morning, everyone. So we thought it was helpful to frame this situation in terms of the dynamic between some of the key stakeholders. And we're talking about effectively the difference in that zone of insolvency when there's a risk that in the short term, there might be a risk of insolvency for the hotel business. So looking through into those key stakeholders, firstly, in terms of the lenders, well, clearly they're going to be focused on preserving the recoverability of their loans. Their first priority is going to be to consider how they can support the group to avoid insolvency, obviously. Pre-COVID, the hotel market has seen a real rise in valuations and lower corresponding LTVs. Post-COVID, however, there's been a dramatic reduction in revenue and downward pressure on valuations. Lenders are going to be weighing up the risks of providing additional short-term liquidity against the uncertainty of the market recovery post-rollout of the vaccine. The usual credit risk factors are going to underpin new money decisions. The lenders will want to assess the value of their collateral cover and the potential to improve this against any new money need. They're also likely to increase the level of diligence over a group's business plan, and should the risks appear high, they might commence their own contingency planning in case they're unwilling to provide additional funding and the group isn't able to source it elsewhere. Covenants, as ever, will remain key, both in terms of the visibility of distress, but also in terms of the negotiating leverage of the lender. Any requirement to provide a waiver for a forecast breach might enable the lenders to improve their lending terms or security position. Defaults typically trigger the rights to enforce if not remedied, and this in turn can lead to an insolvency appointment. Typically, secured creditors have the ability to control insolvency proceedings in terms of the type of insolvency appointment, the choice of insolvency practitioner, and the strategy that can be deployed. This might involve the need to fund an insolvency process in order to generate an accelerated sale of the hotels, or indeed a sale could be lined up on a prepackaged basis, all of which will be considered by the lenders in this period. Thinking about the shareholders, well, the shareholders will be looking to protect their investment fundamentally. And the key question is, do they have an appetite to provide additional capital to meet any new money requirement? They're going to be concerned about where the value breaks, as downward pressure on valuations may put them out of the money. That said, they may take a longer term view of the potential for a market recovery. In any event, lenders typically look to the equity sponsors to share the burden on any new money requirements, so it's likely that they'll need to work in tandem with the lenders to address any new money needs. In terms of management, well, they'll be considering how to preserve and maximise value. They'll be asking themselves a number of fundamental questions like, is it the right brand for the property? Is the operating format optimal? Can the management or franchise agreement be modified or terminated? And does the brand fundamentally want to retain the hotel? Is the property compliant with brand standards? And if not, how material might the property improvement plan be? And they might also consider if the hotel's owned outright, would a sale and leaseback option be appropriate to free up capital? Should the group fall into insolvency, the level of experience of the management team in such a scenario will be key. Often insolvency practitioners choose to transition the operational responsibility or just supplement it to a new management team that's more familiar supporting an interim role whilst the sale's explored. And this also could reduce the costs of the insolvency process. Finally, looking at the landlord, well, in terms of the landlord's position, they'll likely be focused on the trading performance of the hotels. Whilst the trading risks are likely to sit with the operator, the value is obviously underpinned by operating performance. A landlord's going to be closely monitoring the ability of the management team to adapt to market conditions, and they might be thinking about their own contingency options in a worst case scenario. There might be a request to re-gear the lease via a rent concession to provide additional liquidity to the operator. And whilst this might minimise operational disruption and the risk of the landlord having to step in, it might not be enough to stave off insolvency or might just delay things. They'll be considering a number of fundamental questions like their ability to assign the lease to another operator. What impact might this have on any hotel management agreement that sits with the existing operator? Are rights of first refusal triggered for the brand owner? What are the penalty provisions? Could the landlord irritate the lease and grant a new lease to a new tenant? And are there any change of use options available rather than seeking a new operator? So a number of fundamental questions, but hopefully that gives you a sense of some of the key things that these stakeholders will be thinking about in that zone of insolvency. Moving forward into some of the practical considerations, should a hotel group actually find itself in an insolvency scenario? Well, there are a number of commercial factors, and we've pulled out a few key ones that impact strategy and that can be important in terms of protecting value. Obviously, preservation of going concern status is going to maximise value for all creditors. So on that basis, any insolvency strategy really is going to look to continue to support trading operations whilst an accelerated sale is explored. Deposits and event bookings might constitute a material portion of revenue for the hotel, and insolvency appointments are likely to erode confidence, and thereby there's a risk of significant declines in future bookings. Whilst a new operator might in part be able to maintain this business, consideration should be made as to other opportunities to preserve it, such as hiving down parts of the operations into a solvent subsidiary if possible, to preserve that income stream. Ultimately, deposits constitute unsecured claims in an insolvency. In our experience, however, honouring them is important to preserving goodwill in the business, and that should be considered at a strategic level. Again, in the interest of preserving income, brand and online travel agency system continuity is going to be paramount. The fees need to be kept up to date in order to ensure that the booking systems don't go dark on insolvency and obviously impact on the revenue stream. The brand is likely to be subject to a brand operating agreement. Whilst brand preservation is important, the associated financial terms might no longer be attractive in the insolvency period. There are often non-disturbance clauses that might enable the agreement to survive an insolvency, so a detailed review of the operating agreement is needed to determine the options post-insolvency. In terms of health and safety, well, those concerns have always been paramount, but even more so post-COVID. Appropriate PPE, social distancing, cleaning, ventilation policies are all going to continue to need to be strictly adhered to in order to protect both customers and staff alike. This obligation doesn't fall away in insolvency. It's equally important to comply with things like fire safety, licensing, food safety and hygiene standards. So each of these areas needs to be carefully assessed and built into your operational strategy post-insolvency. GDPR's increased the importance of data protection, so an assessment will be required just to review the data controls and policies in place and ensure that they're maintained or improved. And also looking at CapEx. Well, given the funding constraints, CapEx requirements are going to need to be carefully evaluated. You obviously want to preserve capital value, it remains important, but the short-term priority is really going to shift into being CapEx that's needed to operate safely and to consider any potential property improvement plans that are needed to meet brand standards. And finally, planning and property rights are going to be a factor to consider in order to preserve value. You know, looking at things like relevant planning and building permissions might be important, and equally making sure that there aren't any issues like ransom strips that might impact on the realization strategy. So those are just a few of the key considerations. I'll move on to just briefly covering off some of the changes of late in terms of the insolvency regime. You'll no doubt be aware of some key legislative reforms impacting the sector this year, and Joss is going to come on to this in a lot more detail, but I just wanted to draw out a couple of key elements. The government's clearly been trying to provide businesses with breathing space to get through this period of COVID disruption. The furlough scheme provision being extended to March 2021 is a really welcome line of funding alongside other support measures such as rates, holidays, support grants, and government-backed loans. The moratorium on winding up petitions has minimised the risk of suppliers exerting additional pressure on hotel businesses, preventing companies being wound up where the reason is COVID related. And this allied with an exclusion of wrongful trading provisions since the 1st of March this year, enabled directors to consider, for example, stretching creditors just to mitigate their funding needs that have arisen from this dramatic drop in trade. New statutes have offered some respite, but this exclusion on wrongful trading has now lapsed, and the moratorium on winding up petitions is going to cease on 31st of December, albeit there is always the possibility of further extensions. While certain measures may draw to a close, I guess the net result has been definitely to create a more supportive environment this year for hotels to bridge through this COVID period. With that, I'll pass back to Graeme.
Thanks, Ben. So we haven't seen a great deal of insolvency activity in the hotel market in the UK just yet, but as the crisis continues, it becomes even more likely that this will follow. There's some very specific complexities that need to be dealt with, given that it's hotels, but as we've shown with careful planning, you can ensure that value is protected as far as possible in the event that insolvency becomes unavoidable. So with that, I'm very pleased to introduce Joss Hargrave, Head of Restructuring at Bird and Bird, to continue the discussion on this topic. Joss.
Hi everyone, morning, thanks Graeme and thanks Ben. Hopefully we can share the screen there, Russell, thank you. Thanks very much. Yeah, I'm the co-head of the International Restructuring and Insolvency Group at Bird and Bird. Very happy to join you guys today. If you go to the next one, please, Russell. So just very briefly, there's two very distinct elements to English insolvency law. There's procedures that are specifically designed to rescue companies, ideally as going concerns, and then there's the procedures that are designed to wind down and wind up companies. In the first category, the most commonly known will be the administration procedure, and of course CVAs that have been commonly used, particularly in landlord scenarios over the last few years, particularly in retail scenarios. And then obviously winding up, we have compulsory liquidation and voluntary liquidation. Next one, please. So very brief recap on administration, which was the primary rescue mechanism at the time of the last crisis, and that was brought in really to try and instigate a rescue culture in English insolvency, which, as we'll see in a minute, has been taken to another level with the changes that have been brought in. But the predominant change brought in by administration was the breathing space being provided by the moratorium, which basically prevents creditor action being taken during the time of the administration. The administrator, takes control away from the directors, and the directors lose their executive control. I think we'll move on because I think everyone probably understands administration. Russell, please. So the other go-to rescue procedure that would affect the hotel industry would be the company voluntary arrangement procedure, which is highly controversial of late, as I say, particularly with regard to these so-called landlord CVAs, where the landlords of retail and hotel operators have been effectively targeted in order to be forced to reduce rents in order to give insolvent companies the breathing space that they need to survive, albeit that some would argue that may have been abused, maybe being abused currently. We'll move to the next one, please, Russell. So that's a very brief recap of the procedures that existed at the time of the last crisis. The current crisis has instigated the Corporate Insolvency and Governance Act 2020, which is commonly known as CIGA, came into force in June 2020. It's a massive change to insolvency law in the UK, certainly the biggest for quite a long time. There's certain temporary reforms, as Ben was saying, and certain permanent ones. Temporary ones include the so-called landlord moratorium, which prevents forfeiture, which looks like it's certainly slated to end at the end of December this year. But like Ben was saying, I wouldn't be surprised at all if it was extended. The other one is there's a prohibition on the automatic termination of supplier contracts in the event of formal insolvency. And there is a new arrangement and restructuring procedure, and also a new moratorium procedure, which we'll come on to. Next one, please, Russell. So the first major reform, as I say, is the prohibition on automatic termination of supply contracts when a company goes into an insolvency procedure, the so-called ipso facto clauses. As I say, this prohibition applies when a company goes into a moratorium or an administration, voluntary arrangement, or a liquidation, or a scheme of arrangement. Next one, please. So basically, what the position is that most contracts, as everyone knows, will have terms that say that when a company goes into an insolvency procedure, the counterparty can terminate at its option, or sometimes it's automatic. The new law under CIGA says that the supplier of the relevant goods and services will be prevented from terminating, varying, or exercising any right under a contract due to the other party entering into that formal insolvency procedure. The aim of the legislation is clearly intended to try and allow the continuity of supply within the insolvency procedure. And in the past, there have been situations where a supplier has been able to hold a distressed company to ransom, and that won't be permitted anymore. So just considering, I'm no hotels expert, albeit I've acted on quite a few distressed hotel situations, but and no doubt the panel will consider how this type of clause will affect hotel specific situations. But as I see it, the hotel management agreements certainly would class as a supply contract by the hotel operator. They are suppliers of services under the hotel management agreement. So as I see it, they would certainly be caught by this restriction under CIGA. The hotel owners, by contrast, were usually not providing any services under the hotel management agreements, so wouldn't be caught. As I say, perhaps in the panel we can pick up how this might practically affect people. Next one, please, Russell. Yeah, so it's important to note that the restriction doesn't prevent the termination for post-insolvency breaches. So it's not carte blanche to a party just to ignore their obligations. If they're ignoring their obligations post-insolvency, then a supplier would still be able to terminate. And it's also worth reminding people that there was already a procedure whereby essential services such as utilities, communication services, IT, could be forced to be continued to be supplied in a formal insolvency, albeit that the administrator or the liquidator would have to provide a personal guarantee for the ongoing payment if required by the supplier. So CIGA doesn't do away with that. That procedure for those essential services is still there, but what it does is it expands the concept of non-termination for insolvency to all contracts for supply of goods and services, and it does not include the requirement for a personal guarantee from the administrator or the liquidator. So on the face of it, you might think that the supplier would be in a worse position, but actually the monies due to the supplier during the administration or liquidation would almost certainly be payable as an expense of the administration or liquidation, and that means that they get paid before the fees of the insolvency practitioner. So they're highly likely still to get paid. Next one, please, Russell. Yeah. So the if the termination would of the supply would cause, or the lack of termination of the supply would cause hardship to that supplier, then it's possible to go to court to ask the court to allow a termination to take effect. And it can also take effect with the consent of the relevant insolvency practitioner as well, or in fact the counterparty to the contract. Importantly, it doesn't apply, this restriction on termination for insolvency doesn't apply to financial services companies, and it also doesn't apply to financial contracts. So, for example, it will not override the right of a lender under a loan agreement or some kind of financial leasing arrangement to terminate if the lender so chooses. Next one, please, Russell. So then, conscious of time, so I'm rattling through this, apologies, but brings us to the first new insolvency procedure that has been instigated by CIGA, and that is a new arrangement and reconstruction is how it's framed. It's basically a new restructuring plan. It's quite similar to the existing scheme of arrangement that exists under the Companies Act. Again, in a similar way, the creditors are divided into classes, and 75% of value of creditors in each class is needed for approval. But the crucial difference, and this is very much similar to how US Chapter 11 operates, is that the court has the ability to cram down across dissenting classes of creditor and grant final approval to the scheme if it's just and equitable. So on the face of it, you would think, well, if I'm in that dissenting class, then I could be railroaded through this by a larger category of creditor. However, there are checks and balances to this. So the dissenting classes cannot be worse off than they would have been in a relevant alternative procedure, for example, an administration or a liquidation. So the court won't sanction the arrangement if that class is going to be better off, if it actually had just gone into a more usual insolvency procedure. And the arrangement also has to provide for an actual genuine economic payment, and interest for the creditor, and for the company itself. So next one, please, Russell. And then finally, we have the new moratorium procedure that's been introduced by CIGA. It basically imposes a moratorium that's quite similar in many ways to the moratorium that administration imposes. The idea is to prevent creditors from taking action against the company for the duration of the moratorium. It's quite a short period of time. So it's a 20 business day initial period for the moratorium, and it's extendable by a further 20 business days. And importantly, the directors retain day-to-day control of the company. So it's a debtor in possession type procedure, again, quite US style. And it's overseen by an insolvency practitioner known as a monitor. And the idea is basically the benefit to the company in a moratorium is to provide a payment holiday and prevent secured creditors from enforcing their security. And that includes ROT creditors. However, the limitations on the benefit of the moratorium to the company is that there's restrictions on how the assets can be dealt with in the moratorium period, and also during the moratorium, goods and services that are received during the moratorium period have to be paid for, salaries have to be paid for, and importantly, payments under financial contracts have to be paid for. So the point is here, a moratorium is utterly impossible without the support of the bank or the relevant lender. Next one, please, Russell. So just very quickly in conclusion, CIGA was brought in obviously as a direct consequence of the pandemic. It's very, it was rushed in, it's fair to say, albeit not as rushed as some around the rest of the world and Europe. So we're still working out the implications of these changes under CIGA. The moratorium, I'd be grateful to hear what Ben and Graeme are seeing, but the moratorium doesn't appear to be being used very much at all. So-called light touch administrations are however on the rise. For example, Debenhams and Peacock's administrations, where the directors are given a limited role to carry on, even though their executive role has finished. Then I'm only aware of one new arrangement under CIGA, which was the Virgin Atlantic plan, which was very widely reported. Unfortunately, though, the way it was framed was that the creditors were all highly supportive, so it didn't actually get into the issues of the cross-class cram down. So it's possibly not the most interesting test case. And then a final observation on the prohibition on automatic termination of supplier agreements upon formal insolvency. I just think that's going to be very, very helpful to allow a company to carry on in a formal insolvency scenario, and to help hopefully trade out of trouble or allow a sale as a going concern. And that's it. Thank you very much indeed. I'd just like to now introduce Russell Kett, who is the chairman of HVS, and he's going to lead the panel session. Thanks very much.
Thank you so much, Joss. Really good to have your presentation. And if I can just stress to everybody watching us that we're going to be making copies of the slides available, first of all. And secondly, there is a video recording of this at which you'll have another chance to catch up on all the words of wisdom that we've heard from Graeme, from Ben, and from Joss so far. So without further ado, I'd like to invite my panelists to unmute themselves to start their videos, and to do so as I'm welcoming everybody to our panel session. And we've now heard from the experts, the insolvency, the restructuring specialists and the lawyers. So ladies and gentlemen, this is your opportunity to hear from some of the key stakeholders in a hotel investment relationship. So we've got representatives of those who own hotels, those who invest equity in them, those who lend money to them, those who operate them, and those who advise them. And now I've got a set of questions that I've prepared, but I'm happy to put some or even all of them to one side if questions from you, our delegates, are better or more challenging. So please use the Q&A function to send us your questions, and I'll do whatever I can to put as many of them as possible to our panel today, who are Louise Gillan, Head of Hotel Finance at Bank Leumi UK, David Kellett, the Senior Director for Hotel Transactions at Invesco Real Estate, Sharon Quinlan, Head of Corporate Real Estate at HSBC, Andrew Robb, the Chief Business Development Officer at RBH, Graeme Smith, you've already met, who's MD at AlixPartners, James Salford, partner at Bird and Bird, Joss's colleague, and Aaron Taggart, Head of UK Investment for Cheney Capital Management. Ladies and gentlemen, welcome. The theme of our panel is minimizing the pain, maximizing the opportunities. So quite a few of the questions that I have are based around this theme, but I'd like to start with a repeat of the question that Karen asked our delegates at the start of the webinar. When, ladies and gentlemen, do you expect we will start to see a material increase in the number of hotel insolvencies? It's a very simple answer. You've got 5 alternatives. Before the end of Q1 next year, somewhere between Q2 and Q3, Q4 or later, 2024, or no material increase in the number of insolvencies and putting people like Graeme out of business. So a quick answer all around the panel. I'm going to start with James. Tell us your answer. When do you expect?
Thanks, Russell. I mean, it's very clear there's been a lot of support from the government, from the lenders, who I think generally have been fantastic supporting the industry.
I'm sorry, James. I want a one-word answer.
middle of next year, Russell. I think.
Middle of next year. Aaron?
I'm going to be more optimistic and say, I'm going to say later, 2024.
Okay, Louise?
Q3.
Q3. David?
Q1.
Andrew?
Q2.
Sharon?
Q3, Q4.
And Graeme, finally.
Yeah, towards the end of next year.
Okay, so what are the factors, and I will give you more than one word to answer that, I promise. So what are the factors that you think are the most likely ones to trigger hotel insolvencies when they do come about in wherever you are, wherever your mindset is in the future? Louise, what are the factors that you think are going to consider to be most likely to trigger?
I think it depends how much additional debt the companies have taken on in the short period against how they were financed. Those ones that perhaps financed at the top of the market at high loan to value ratios have less ability to accommodate the holding cost that's been required over the period. And obviously Q1 is going to be a very low trading period, even if the hotels are open. So there's a lot of pressure on a successful Q2 trading period. So I think that there will be questions that will be raised in Q3 as to whether or not the level of debt that's been that's held is appropriate for that asset.
Terrific. Try and stick to one factor. David, we've heard about the level of debt. What do you think?
I think it's the tenant entities, particularly around Europe. And I think there's just a lot of constraint given the level of rent payments. It was touched a bit on the presentation. I think it's less relevant perhaps in the UK, but across the continent, I think that's the biggest thing. And that's where the distress is going to come first and fastest.
Okay. Aaron, what's your view?
I think for us, it's going to be volatility of values. It's going to be very difficult, I think, for the valuation community to really get a grip on what forecasted trading is going to look like over the next couple of years. It's, you know, there's so many big swings potentially in the offing here, and I think that's going to be the big issue, I think, next year and into 2021 and 2022.
Terrific. Sharon?
I think it's businesses running out of cash, basically. I think fundamentally, you know, support and help has been made available either from the finance community or from the government, which has been incredibly helpful. But the costs of getting some businesses back up to operational efficiency is actually quite extensive. And if you haven't got the revenue coming in, because there is a slow build up to, you know, to prior performance, funding that operational efficiency on the back of potentially high leverage that Louise talked about, et cetera, it's having that ability to sustain your cash flow.
Okay, Andrew, what's your thought?
I completely agree with what Sharon's just said. I think for me, liquidity is the biggest challenge. I think that's why I think I'm probably slightly earlier than some of the other panelists, because I think the support that's available will actually, I think I agree, it'll probably be that later period, but I think the hotels that are just struggling to get to that point, I think it's going to be purely cash flow over what would normally be a weaker trading period anyway. So going into that period without sort of the cash reserves that would ordinarily have seen them through that, I think is the biggest challenge.
Indeed. James or Graeme, got anything material to add to what the other panelists have said?
I think one thing for me, when you talk about cash, the other thing that plays into that is actually the relationship between the sponsor and the bank. Because I think when you get into the need for cash, then if you've got that constructive relationship and there's that trust there between sponsor and bank, then, you know, you can kind of find a way through if people believe what's there at the best time, the current time is the best to see it through. So I think that relationship is important.
It's just to interrupt, sorry, just Graeme, you mentioned earlier on as well, just about transparency as well in terms of information. I think that's where that's absolutely critical in terms of that relationship there, just in terms of visibility of trading information and the ability for that lender to sort of see the business and know what you're doing and that you're maximizing the opportunity there and minimizing costs as much as possible.
Excellent. James, you got anything to add?
Yeah, I think ultimately that the owners who've got equity behind them and are able to still put the cash in will be fine. I think the challenge will be those who have run out. I mean, people mentioned relationship with the banks, that's clearly important, but a lot of banks have already provided liquidity lines. We're starting to see people come back and ask for a second liquidity line. Well, there has to be a limit as to how much cash the banks can put into these deals as well. So some of it will come down to eventually whether or not there's the equity there to support them.
Terrific. Liquidity is clearly in the mind of at least one of our delegates, and we have somewhere over 400 people with us today, and I've just picked one out who says, how do you align the interests of the landlord with that of the tenant in the liquidity challenges we face with respect to leases, particularly fixed leases, where interests may be misaligned? David, is that something you want to kick us off on?
Yeah, no, I guess when you started the question, Russell, I thought that might come my way. I think this is one of the key points, and of course, this crisis has highlighted some of this challenge that probably existed already, but wasn't necessarily faced up to, but it's become more apparent. And I think there's a couple of things here. One, leases have been signed; they'll have high fixed rents in. Landlords will have security. There needs to be a discussion because there's a liquidity problem. It may well be in the best interests of both sides that, you know, the two parties continue their relationship, go forward. It may be in their best interest to go their separate ways. Who knows? But there needs to be a fully transparent discussion around that, around what might happen. I think on the go forward basis, I would expect a reduction in fixed rents and probably a greater introduction of variable rents into lease structures going forward. that provides a greater alignment of interest. But then it has to come with the transparency and all of that openness that actually makes it more of a partnership than, landlord tenant being, at odds with one another. So I think, one of the benefits of things like of any crisis, actually, it should give a better way of doing things in the future. But it may be that there's just a greater appreciation of some of the embedded operational risk when it comes to lease restructuring.
I just offer it out to the rest of the panel in case anybody's got something materially to add to that.
The only thing I would add to that is that we've got one at the moment that we're working on where the fixed rent is pretty high, and at the moment that's understandably unsustainable. So I think extrapolate what David said there and bring the lenders into that conversation as well, because if you're going to look to reduce fixed rent for a period of time, then really you need the alignment of the lenders and the lenders to buy into that, because you may have to factor in lower interest payments or interest holidays or whatever mechanism you use there. So yeah, you need that real alignment of interest and deep discussions between all of the parties, whether it's landlord, tenant, and lenders, and ultimately equity.
So you talk about interest holidays and reaching an accommodation with your bank. Lo and behold, we have two bankers here. Sharon, Louise, either one of you want to comment on your likelihood of entertaining some sort of an accommodation?
Yeah, I think, sorry, Sharon.
No, go ahead, Louise.
I think from our point of view, you have to start working as a team, whereas before it was very much tenant and owner. Perhaps the owner didn't receive as much information as required to be able to get comfortable that that business is going to be able to recover, and for the lender to be able to take a view as a result. So I think this full transparency issue is what needs to be worked on in the current circumstances. The lenders need to have the information to be able to buy into the future of the relationship between the two. And I think as long as that's provided, then yes, we have to work with all parties.
I think as well, it goes to the degree of leverage in the structures, actually. I thought one of the points that Graeme made in his presentation was quite interesting. In the financial crisis, it was a very highly levered system. And, I don't know, loan to values might have been 80%. And of course, then they would now be effectively the owners. A lot of certainly on the European institutional side, leverage might be 20, 30, 40%. It's not necessarily particularly aggressive. And so it's less of a problem, I think, in this crisis. But clearly, if you've got leverage in the debt, leverage in the landlord-tenant lease, the more leverage there is in there, the faster these things fall down. But it feels to me that we're in a slightly less levered environment this time around, and more of the leverage is more on the operational side than necessarily perhaps on the bank. I know it'll be different case by case, but
my own experience is that there's been a lot more common sense approached to preventing that loan to value when you put it through the capital stack, rising to beyond 75 and God forbid even higher. Sharon, anything to add to what's already been said on this?
No, I think the leverage point is very well made. I think everybody has a greater chance of working together and finding a mutually beneficial position and solution if leverage isn't pushed at every aspect of the of the structure. If you're working in an environment where your leverage has been pushed across the whole structure, then clearly it will be more difficult. But I do agree that engaging with your lender and talking to them and being open and honest about that situation is the best way to try and find a solution through.
Terrific.
And there's two things as well, Russell. One, sorry to interrupt, but one thing is fundamentally, if from a lender and investor point of view, this is nobody's fault. Yeah, fundamentally, COVID is nobody's fault. We're all trying to deal with it. We're all being very pragmatic. And I think secondly, certainly from a lender community perspective, the experience now out of GFC, I think, is invaluable to help get through this in an incredibly difficult period.
You disappoint me. Everything I read, every newspaper I pick up, every TV program, someone always wants to blame somebody. And you're saying, Aaron, nobody's to blame. We can't put the blame. I mean, I'm looking to put the blame on Graeme for a start. But look, let's get off the immediate topic and onto something that is burning the hole in the brain of one of our audience this morning. We want you to give us your thoughts, ladies and gentlemen. It's normally difficult enough to deal with one shock at a time. So with a shock to the system like COVID having to work its way out, we've got Brexit coming down the line. So that could create a double shock with no known outcome to either. What a pessimist Mr. Dunn is. But ladies and gentlemen, what's your view? How are we going to cope with Brexit on top of everything else? And who's to blame for that? No, you don't have to answer that. James, kick us off with your thoughts on that.
Sure. I mean, I guess if you look at it from an industry perspective, you know, people will still travel, people will stay in hotels, assuming we can all go back to some sort of normality next year. I think the industry, Brexit won't impact in that sense. And in some ways, if sterling depreciates further, that of course will encourage tourism. So there may be some positives coming out of it. I think the flip side to that as well is in terms of investment, we're still seeing an awful lot of capital coming out of the Far East, coming out of the Middle East, with people desperate to invest in hotels. And one of the sort of flip sides of COVID is actually hotels still looks relatively attractive as an asset class compared to, say, offices or retail, which have their own challenges. So I think as an industry, yes, there's Brexit. Yes, it may well have an impact. It may not necessarily be negative. I don't think, certainly for our industry. I'm sure it will have impacts on other industries in different ways.
Graeme?
I think that the challenge of Brexit, I think, really throws into sharp focus the need for the government to support the sector. Because if we think about, you know, an industry, hospitality and leisure more broadly, hotels, restaurants, pubs, etc., you know, they are kind of great employers of people when economies recover. So I think, you know, with Brexit impacting and possibly having, you know, quite detrimental effects on other parts of the economy, if we can rehabilitate hospitality and leisure quickly, it's a great source of employment that people can get into at speed. So I think it just throws into sharp focus that need for government support.
Andrew, what are you and your business doing to prepare for the rigours of Brexit and the impact that could have on an already depressed operating scenario?
Yeah, for us at the beginning of 2020, Brexit was quite a big issue, particularly with a strong London base. We were particularly concerned about the employment issues that we're going to have and the lack of people available. I think, if anything, COVID unfortunately has led to a number of job losses. Therefore, the talent pool out there has increased dramatically. So I think from our perspective, actually, we're not too concerned about the short-term impacts from Brexit, because that was our major concern. And at the moment, that's not an issue that we think we'll have. I think there's plenty of excellent people in the hospitality industry that have sadly lost their jobs and will be looking for jobs. So hopefully, if there is that upturn, there's plenty of available people.
Aaron, are you seeing the same thing in the businesses you're involved in?
I think COVID is such a profound shock that, in comparison, I agree with, I think Rishi Sunak came out the weekend and said, I think he was asked a similar question. I think I agree with his answer, which is, in comparison, COVID is such a profound impact on the economy that Brexit, in some respects, is almost not quite negligible, but in comparison. So I think we're all focused on COVID and how that plays out over the next 12, 24 months, rather than focusing in on Brexit. I think one issue at a time.
Interesting. I saw in the paper, I think it was only yesterday, that a former governor of the Bank of England was saying that Brexit is going to have an even bigger impact than COVID. Is that your view, Lewis?
On hotels, I'm not sure there can be a bigger impact than COVID on hotels. So no, I think that I agree with James that actually I think if there's a further devaluation in currency, then it could be beneficial for the hotels. And obviously we were all very worried about the employee situation, and now there is unfortunately a bigger pool of people there. So actually I think that the challenge of Brexit has been minimised by COVID.
And same for you, Sharon?
I definitely agree that, you know, everybody wants the demand for our hotel and leisure industry to pick up again and re-emerge out of this pandemic. And I think the tourism point around the devalued currency is very valid. I think the combination of coming out of COVID and Brexit together, I mean, we are looking into a long-term, you know, economic challenge, to put it optimistically, and I think that will have an impact, undoubtedly. So I think it will take longer for businesses to re-establish itself. People will have less money to spend. So you know, the economic position as a result of this pandemic and Brexit isn't necessarily on a combined basis filling me with, you know, lots of optimism, but I think it is definitely, you know, there is a way forward, and I think if businesses can ready themselves, then they'll definitely be in a better position than they are today.
David, I know most of your interests are not in this country, so Brexit is perhaps an issue that reflects it from a different perspective. Very quickly, if there's anything for you to add, please add it, but I've got another question that I'm itching to ask.
No, nothing for me.
Okay, so one of our audience has said, the hotel business model has changed fundamentally. Landlords are being asked to change their lease terms, but are hotel brands changing their franchise or management agreement terms? Often these agreements are of long duration. A good question. Are we seeing HMAs, franchise agreements and so forth that are being wielded by the good and the great of the hotel sector? Are they doing something to change their terms? I mean, lawyers probably come across this more quickly than anybody else. James?
Yeah, thanks, Rob. So, I mean, if you go back, you've got to look at the market at the moment. That the hotel brand obviously is struggling to put flags on new hotels at the moment because very few people are building them. So if you go back to the great financial crisis and what happened there, what we saw was pre that the terms that the brands were putting out were very, very one-sided. There was a marked shift after 2008 for those management agreements that got signed. They were very much more owner friendly, and that trend sort of continued right up to pre-COVID. So my suspicion will be that it will happen. It probably isn't there yet, but we think as and when deals start to come through, I mean, I know Karen's working on a number at the moment, but relatively it's a small number compared to where we were pre-COVID. My suspicion will be, once again, the balance of power will shift, that the brands are obviously competing with each other massively to put flags on hotels. And so we will see a real sort of drive to try and get new business. I think the one challenge to that, what we saw in 08-09 was the brands prepared to throw money at owners in the form of key money and the like. Obviously right now, all of those hotel companies are suffering severe financial stress as well. So whether they've got the capital to deploy to sort of win those mandates, to win the brands, we'll see. But I suspect we will see a shift again more in favour of owners. I mean, it still comes back to the brands tend to have very one-sided documents though, but I think we'll see a shift in favour of owners again.
Yeah, I'm seeing activity from the brands offering key money to help move to their conversion brands, where you don't have to have so much physical capex in the hotel, but just to ease the pain of that. I'd like to move off this subject unless any of the panel wants to add anything materially.
Yeah, I think actually, Russell, I think it's a really interesting point about the brands and their role in some of these restructurings, and it's actually very different from what we've seen in the past. So when the restructurings were bank-led, bank preference was often just keep the brand because it keeps the delivery system coming in. We're now in a market where there isn't any revenue, let alone brand-led revenue, and in some of the restructurings we've been involved with, the control is far more with us as the landlord, and we take much more of a an owner's view of it rather than a bank's view of it. And it all varies jurisdiction by jurisdiction. I was interested by some of the comments on the UK that particularly that Joss was making about how some of those supply agreements change. Across Europe, my experience is that's very different in different jurisdictions. And it means that some of these brand agreements become far more negotiable as you go through. I think where the brands suffer is this, continuation of, forever term. I mean, whatever you want. I mean, it's 20-year, 30-year terms on these agreements, and some of the contractual terms can be rather onerous. The brands tend to have very good legal advice and very good legal contracts in their favour. So it's, I think, it is actually something that should be a bigger focus, because it's not just sort of landlord tenant or owner operator. Those brands are really in this, and I would think they probably see a ton of risk in their pipeline, not yet coming through, but a load of developments won't finish, won't get built. So I think it's early days for the brands on some of these deals, but I would probably think that it's a bigger point and maybe a different reaction to some of the ones you've talked about, and but it's a bit early in this cycle to see how it plays out.
I'm just going to quickly add, Russell, just from our perspective, I think the approach to contracting and flexibility and alignment, I think, is the key thing. Making sure that you're going in with the owner with their eyes wide open in terms of their business plan, and making sure that our commercials as an operator are aligned to that business plan. I think that's the key thing. But I think from the brand's perspective, the one thing I would say I'm a little bit nervous of in terms of the conversion brands that you mentioned there is making sure that they're of a good enough quality. I think what I'm a bit nervous of is some brands with an approach of a very light touch branding, and I think that's the danger of sort of devaluing a lot of the brands, and particularly if I was an owner who just spent money doing a fully fledged brand A, and the guy next door has now done a brand A for a lot cheaper, I'd be particularly peeved. So I think that's a big issue from a sort of consistency and quality of brand, and I think just needs to be watched in the next sort of 12 to 18 months.
Okay, we've spent a lot of time dealing with some of the negative issues and sort of minimizing the potential pain and what we could perhaps be doing. But let's just change track a little bit and talk about how hotel companies can maximize the opportunities which are going to present themselves at this time, where maybe from an operational perspective as well as from an investment angle. What do you think, Aaron? How can hotel companies maximize some of the opportunities that are going to be available?
Good question. I think from our perspective, going back to one of the points that was made earlier, I think that the staycation has certainly come back into vogue, which leads me on to one of the challenges. I know we're supposed to get about positives here. One of the things that we haven't talked about yet, which I think is a real key aspect for us going forward, is demand. Is the one issue that I think that we wrestle with. Looking at some of the hotel business plans that are coming across our desk at the moment, I do think that the domestic demand will hold up. And if there is, as James said earlier, a devaluation story here, and in inward tourism, I think that bodes well for the UK. I think the one structural challenge, because we were talking about earlier about some of the other structural issues that some of the subsectors of real estate in the UK face into at the moment. So whether it's offices or retail in particular, there's some structural issues there. We're just wrestling with whether there is a structural issue here for hotels, and certainly on corporate level. The one thing that the pandemic has forced us to do is to test the technology, and technology works. It might not be ideal, but you extrapolate that into things like ESG, which are coming further and further up the agenda, and your global footprint and your carbon footprint as a business. And I just have concerns about, and I'd like to, you know, throw that kind of out to some more learned people on the panel here as to what they see, because that's something that we certainly is at the forefront of our mind when it comes to hotels, and hopefully it's a positive thing, but I do see that as a bit of a challenge.
Okay, Sharon, what's your view on this topic?
I think it's really interesting. So, you know, if I look across the book that I've got of hotel assets, when I first looked at it, you know, there was a fairly, a more London and city centre centric sort of focus for the hotel assets. And, you know, when I first look into that, I think that's a really positive thing. Clearly, COVID has taught me something else, in the sense that those that have recovered more quickly over the summer months have clearly been, you know, coastal assets, and those that are in more holiday places and locations. So to Aaron's point, you know, is that a structural shift? I don't think we know yet. I think it's too early to tell, if I'm honest. I think you know, a lot of the London-based and city centre hotels are very dependent on overseas tourism, on corporate activity, and I have to say I do think that will come back. So I do think those assets will, you know, have the opportunity to survive and thrive, actually. So I think that's a good thing. But I think there will be an increasing utilisation and use of UK staycation hotel assets. I think partly for the ESG reasons and the, you know, the environmental reasons that Aaron talked to, because I think that issue has come up the agenda of, you know, not just large corporates, but us all as individuals, and a recognition actually that, or a greater recognition that, you know, our planet has arguably limited life, and there are things that we should all be doing to improve that longevity. And, you know, less overseas travel, etc., is some of that. So I think there could be some structural shift in the way that you know, society utilises hotels, but I think it's too early to be clear on what that will mean.
So, David, are you going out and buying regional country house hotels in the UK?
No. I think a bit of it comes back to the type of investments. We're typically longer term than that, and I think in the long term, the big cities will continue to be the sort of the store of real estate value, and you know, if you think about a market like London, I mean, the UK government can't afford for London to sort of fail, right? I mean, it just can't. So the overall government machine will push things back towards the big capital cities over time. And really, right now, I think this is a really good opportunity to buy in those core markets. Yes, short-term staycations, all that stuff, but on the sort of more institutional side, it probably just doesn't really quite fit the bill. We'll probably have another look at resorts, because we sort of always do every few years, but it's always been a struggle for institutional investors to go to the resort side, but doesn't mean that we shouldn't. But I suspect core money will get more core coming out of the recovery.
We'll look at resorts perhaps on another occasion. Always fascinates me, but I won't delve more deeply now. Louise, are you still glued to the core markets? You know, is London still your favoured place to lend money?
It is. I think there's still a lot of interest that's coming into the London market still. And London is London, it will always recover. But I think the regions are interesting. I think that there is an element of guests that have never staycationed in the UK that will have to staycation next year, probably. And it will be interesting to see how long the benefit of that new staycation market stays with us. I think probably the best thing that's come out of this is the fact that hoteliers have actually had time to sit and really analyse their costs And I think one of the things we will see going forward is much more efficient businesses. And it will be interesting to see when projections start to roll in, how they compare to the previous year, where those unnecessary costs have been eliminated, if they can be eliminated. But I think there will be a structural change in how the hotels are operated from a cost base, and that's interesting.
That's a very good way of segueing into Andrew, isn't it? So
I'm nodding away there, Louise.
But you're on the spot. How much have you been able to shave on average in your typical hotel operation as a result of COVID? What have you taken out of the cost structure?
I think what Louise touched on is right. I think we've never had an opportunity as an industry to take everything back to a zero base. And that's been probably the big benefit of that, particularly operating so many hotels across many different owner groups. And a lot of those hotels would be ones we've inherited rather than sort of started from scratch. So to take the opportunity there, particularly around payroll, I think it's probably obviously the biggest cost in any P&L, but the biggest area where we've also looked to save, just looking at different ways of working, trying to put everything as much as possible onto the same structure. Obviously, we've been having discussions with staff about hours, about types of contracts and things. So the ability to consult there and to try and put people onto the same and really start from scratch. And I think the key point for us and any operators moving forward, I think, is to make sure that that cost creep doesn't come back in, that actually we stick to this minimum and only increase where you're then justifying any cost increase as a result of additional revenue. So I think for us, that's the key over the next 12 to 18 months, is making sure we stick to that and are very clear to the owners that if there is any cost increase, that it's justifiable and sort of signed off.
So I didn't hear a percentage mentioned in the course of that.
Well, I think it's very difficult percentage-wise, because obviously a number of the costs in our businesses are variable as well as fixed. So to say last year to this year, I think is a very difficult number. But I think the key at the moment is making sure you're stripping everything back to the bare bones, so that when we build now moving forward, then it's from a key base. I think comparing this year to last year, I think is pretty difficult on a percentage basis.
I would always encourage people to have in mind that whenever I've discussed this with other people, most of the hotel operators have been very proud to say that 30 to 40% of their cost base has been able to be stripped out, which brings them back to a sort of zero base that they then, as Andrew has been saying, they then have the ability to add to, but when the revenue dictates. Thank you. I'm going to move on. I'm sure we're itching to get on with as much as we can, and we don't have an infinite amount of time. So a wild card question from the audience. I don't know how many of you have been involved with so-called big box hotels, but they're the ones that have got big meeting incentive conference business. They're the ones that are probably the quietest at the moment. How can we repurpose some of these hotels to be able to be more attractive to the business that's going to be out there in the future, looking at the immediate term and maybe looking at the longer term? Aaron, I don't know whether you've put your mind to that sort of an equation, but how would you do it?
Really, if I'm honest, we are, we're mostly lenders, Russell, into the hotel sector. We're not owners, so we probably don't lay our mind out that far. So I think it's probably a question for one of the others.
Well, David used to be involved in big box hotels in a former life that I remember. Have you given any thought to this?
Yeah, I think it's probably, I think the first thought is probably grateful don't own any of them at the minute. But in a way, I think if you take the question away from this one, so you think these huge conference hotels that we all go to, IHAF, we all go there, huge conference hotel. I do believe that they will recover, and probably faster than all of the models out there say, because I think there's always a bit of a snowball effect, that we all start going back to and then 2 years later things kind of will get back. I think one thing that we're really looking at actually on all of our hotels at the minute is, what is the alternative use? And again, it goes back to why you might buy in those prime and in the sort of city locations, because it might be that conversion to residential might be possible, right? Maybe not, something to look at. Conversion to maybe some service departments, or splitting use between, you might take one 500-room hotel that was a, I don't know, big Hilton, and you may say, oh, well, actually, that may make more sense to be a 300-room Hilton with a 200-room extended stay product, or a 200-room Hampton, or something different. And I think that's the question is probably more of, what is the right use for the real estate going forward? How do we, if we can't always do it, how could you change use and value, and in a way use some of this to actually be able to create some development value out of some of the projects that we've got? And we've lost a lot of value, and actually to try and gain some of that back, it might be by looking at sort of wider options rather than just let's just invest in the hotel we had before, because I think things will change. Don't know how yet, and I think it's something to watch, but it will just lead into, I think, different, real estate decisions on the way forward.
So Sharon or Louise, have you got any lending out to a big box conference MICE hotel?
So I would say thankfully no, but we have exposure to smaller hotels who have a lot of conference facilities. And there's one train of thought that some of those owners are suggesting, in terms of, with the structural change that is perhaps forecast in the office sector, that actually there will be a greater use of localized conference facilities by big corporate occupiers of office space, in the sense that they're reducing their own office requirements, and will use conference facilities in local hotels perhaps a bit more than was the case in the past. I think it's still very early, and it remains to be seen whether that will actually materialize or not. Personally, it's a completely different topic, but I don't think that the office is dead. So I think that there's a balance to be had there. But I think the alternative use question is one that will continue to play a part in everybody's thinking as we move through next year and beyond, actually.
Okay, I'm going to move to my last question. Just before I do so, I'm just observing that you talk about the office is not dead, and you've got 8 people on the screen at the moment, all working from home. So I suppose the home office is not dead. Last question, ladies and gentlemen. I want to thank you for your time this morning, but I want one single piece of advice. And so if someone has already taken this piece of advice, you've got to find another one. So what single piece of advice do you have for a hotel owner who is facing financial difficulty at the present time, to be able to avoid having to go down the insolvency route? So one piece of advice, short and sweet. Louise, what's your one piece of advice?
To talk to your lender. Full transparency, early collaboration.
Aaron?
Louise has nicked it, but I think explore options and be creative. Yeah, there is capital out there, like us, for example, that can come in and plug a gap for a period of time. So explore options and be creative. There are options out there. David?
Prepare early and fully, and hire good advisors.
Okay. Sharon?
So I think Louise and Aaron have clearly got mine. The other thing I would say is recognise within your own management function if you haven't got the necessary skills, and actually get them, acquire them, or use advisors, but recognise where you're missing experience.
This question gets harder as I move down the line. Andrew?
Yep, I'm scoring them all off as you go. I think I agree completely with what they've said. I think for me, be positive as well, because I think there is still business out there. I think just because we're in a tough environment doesn't mean that you can't still outperform. So keep looking. There is business out there, and yeah, just speak to everyone and over communicate, I think, is the key thing.
And James?
Thanks for coming to you last, Russell. I think a combination of everything. I mean, I think, yes, talk to your lenders, but think both in terms of your short-term funding needs and also the longer-term funding needs. I think everybody's been very keen to raise capital short-term, and people haven't necessarily thought, how am I going to refinance? What's the capital going to like once I've borrowed this money? And I think go prepared, having thought about all of that, both short-term and longer-term financing needs.
And despite what you thought, James, you're not the last. Graeme, you kicked us off this morning. Have the last word of the panel.
I'd say don't be dogmatic, accept that there is uncertainty. So whilst you may have your own view of what the forecast might be, what you're really staring at is a set of scenarios. But under each of those scenarios, be able to explain to your lenders and your sponsors how you deal with them, so they've got the confidence that you're the right people to see it through.
Wonderful. Ladies and gentlemen, thank you. And it's now my pleasure to hand back to Chris to bring things to a close.
Thank you, Russell. That was a fantastic panel. Really enjoyed that. Covered everything from Brexit to staycations to the return of city centres, offices, big box hotels. Really fascinating, and hopefully that gave everyone a lot of information to go away with. Thanks to all the speakers. I thought they were a great set of presentations over the last hour and a half, to Ben, to Graeme, to Joss, and obviously to the panel. So thank you. We said we want to return to that poll question. So let's just, if we can, Lauren, can we just bring up the poll question and just see whether your views have changed? Now you've heard the experts. When do you expect material levels of insolvencies to start occurring in the UK? Yeah, very interesting. Almost just a little bit higher, I think, isn't it? So Q2, Q3, 2021. So we're obviously going to face quite a fascinating year as we go into next year, and the challenges that we face with all the various scenarios. Thank you again. I think we had over about 400 people join us today, so thank you. We will be releasing the recording a bit later on today. For those who want presentations, please let us know and we will get the presentations to you. But it's been a fascinating session, as I said. Thank you to everyone for joining us. Thank you to our speakers, and I wish you the best of days. I look forward again to meeting you again. Goodbye.